We have referred to this as an introductory or foundational course. What we are going to cover today is everything but introductory or foundational. The concern I have is that when people are starting to learn to trade, the only real experience that is meaningful is to actually enter orders. I mean, you can do a lot of groundwork and you can paper trade, but until you put on real trades and feel all the emotion that is part of trading, it is very hard to really get the experience you need. Once you do start trading, most people run out of money before they've ever had enough time to get a fighting chance in the market. And a lot of that is because they're not introduced to the more important concepts. When you trade, every order that you enter is up against the best in the world. It's not like if we're learning to play tennis. We can start with people that are, our experience level, and we can work up the ladder as time goes on, taking years to gain the experience to be competitive. We don't have that option when it comes to trading. There are no ladders. The first day, the first trade you enter is against the best in the world. In most introductory or foundational courses, they don't even begin to touch upon those things you need to even survive in the market while you are gaining the experience to be competitive. So we're going to go through today, we're going to cover some concepts that I think are extremely important. Hopefully you'll have this in front of you, you'll listen to it, and then you'll be able to go back and listen to it multiple times. And every time you listen to it, it'll probably make more sense. Well, I will find that most people will come back and listen to this again after they've been trading for a while. And then all of a sudden you say, wow, I missed that on the first time I watched it or the second time I watched it. But understand, it's part of our foundational course, but it's everything but foundational. All right, I'm going to ask Jen to start the recording. So that'll take about a minute. While we're waiting for the recording to get underway, on the far left of the graphic, we are looking at a day where the market broke out to the upside from the previous all-time high. What has caught my attention is that all the single prints on the bottom, and there's a huge gap below that, but there's no elongation on the upper part of the profile. So that tells me that we probably had a lot of short covering, but we didn't have a lot of new money. And then the following day, the market, was very stubby, but it was trying to go down. And we got overlapping the higher value. And then the third day, as you can see, the market went to new highs once again. Jen, can you pull it down so we can see the new highs that were made earlier this week? And you see once again that spike, and you see that very elongated day with no real elongation on the highs. When I see something like this, I know that the volume was low and I know the structure was poor. I know that's a very good odds that the market is going to retrace a lot of that range. What happens to most people, they've seen price go up for 3 days. It's very hard for them to adjust for the potential of that market coming back down. All right, let's go back down and let's take a look at what is happening today on the 31st of August, 2018. Okay, Jen, can you stop it for just a second, please? Okay, the market broke yesterday afternoon on the 30th. And if we can go up and look at the top of the 30th, what we're going to see is that there's a very poor high. We're a single tick on the top, and then it's 4 wide across that. When I see that, that tells me that there really was no completion to that day. So we say, well, what happened? Why wasn't there? Well, one of the reasons that we wanted to show you this day is that as traders, you always have to deal with the unexpected. I've already commented that I didn't think the volume or the shape on the rally to new highs was very good. And it didn't look like it was anything other than smaller time traders. And when we see that, there's a pretty good chance we'll come back down through it. However, it is not uncommon for the market to need some kind of catalyst in order to shock it into the retrenchment. If the 3 days following the upside breakout, or including the first day of the upside breakout, were really strong, and then we get some, event that could be considered a catalyst, the market might dip down very shortly, or for a very quick dip, and then that's a buying opportunity, and then the market usually proceeds to new highs or past the original high for that day. However, as I said, if the underlying structure is poor and the volume is poor along with it, then that piece of news, or whatever the catalyst is, can cause the market to drop very quickly and not recover to the same speed that it would if the market itself were strong. Now, what happened on the afternoon of the 30th is that the president announced that there would be an additional 200 billion in tariffs placed on China at the beginning of next week. And of course, no surprise, at the end of the day, as we go into the night session here and day session in China, you of course are going to get China talking about retaliation. Now, we've seen these discussions on tariffs for some time. The first time we heard them, they took the market down substantially. Each time it's become an issue, the market's gone down less and less, and then followed by rallies to new highs. So you need to understand that when the market's looked at something and the first time it sees it, it gets all excited. And the more and more that it hears of the same thing, the less and less reaction there is in the marketplace. All right, so on the afternoon of the 30th, the market broke. You can see the L period low, which occurs late in the afternoon. The market then came up and settled off the low and left us an extremely poor high. The first thing we have is after the market closed on the 30th, we get the overnight trade that occurs on the night of the 30th and prior to the opening on the 31st. Now, just to be fair, understand that the 31st is the last trading day of the month. It is the last trading day prior to a long weekend. So it'll be an unusual day, but the educational or foundational points that this day showed us are absolutely wonderful. So as you see on the far right, and we can start trading again, you see the overnight inventory is short, and that is measured from the green circle on the left, which was the settle on Thursday. And then we say with any trade that took place below that was short. So almost 100% of it was short. So the market opens on Friday, the 31st, and we open within the overnight range. Notice the overnight market took out yesterday's low by just a couple ticks. So there was no, real push to the downside. Overnight inventory is short. When overnight inventory is short, the basic rules, which we've talked about before, if the overnight inventory is short and the market doesn't show a counter auction or an upward move, then the market itself was very weak. If the market shows a counter auction or trades upward but doesn't fully go through the overnight range, then the market more than likely will turn back down. If the market trades upward and takes out the overnight high, that is usually one of the most misleading types of days for most traders, particularly those traders that are price-based. So one of the things I really wanted to focus on today is one more time to bring home to you the idea that price is simply an advertising mechanism. The majority of short-term traders do not make money. The majority of short-term traders are following price. Price is the easiest thing to trade. They have all kinds of tools that measure it, but it's all based on a single dimension of price. When the market starts to cover overnight inventory, it means if it's short, how do you cover a short? You have to buy. When you buy to cover a short, you are actually weakening a market because you are removing potential buying power from that market. Remember, there's only one way to cover a short. You have to buy. So if the market is short and people start buying or covering those shorts, that takes out some underlying support for the market. If a market trades through and above the overnight range, that usually gets traders very excited. They think the market is really going to go up. And so you have to be very careful. A day where the market trades above the overnight high, particularly coming from the lower end of the overnight range, and then trades back down, that is probably the most misleading early morning trade activity that you will ever encounter. When the market trades up through the overnight inventory, you normally have momentum or other price-based traders jumping on board. So it's not uncommon to take the trade fairly well above the overnight range. If we don't follow through and take it very far above the overnight range, then the potential is that we trade all the way back down through the overnight range. It's like we talk about trading balance. If you come out of balance on one side and fail, then the destination trade is the opposite extreme. It doesn't have to happen. It's just you have some idea and how to judge accordingly to what is happening. What does it look like the chances are we're going to be able to make that destination trade? So if you trade above the overnight high and you don't follow through to the upside, the destination trade is the opposite end or the low of the overnight trade. Now, clearly it doesn't happen that way all the time, but you want to be aware that that is potential. Where now, another thing that comes into play is thinking in terms of bets or thinking in terms of odds. Thinking in terms of bets, I have suggested, I'm sorry, Jen, I drew blank. What's the woman's name?
Annie Duke. Annie Duke wrote the book Thinking in Bets.
Yes, it's a wonderful book to read as you're preparing for trading. And one of the things that we're always talking about is how much confidence is there in a market. We're going to see that confidence in play twice today. And that's another reason I wanted to use this day as a replay. It wasn't originally scheduled, but it became such an educational day, we threw it in. So one of the things that determines odds, if the market is trying to go higher and volume is low, then that lowers the odds of upside continuation. If the market is trading higher and we're getting higher volume as the market goes higher, that's a very positive sign. Good chances for upside continuation. Normally, if you go higher, you are advertising for sellers. If you go higher and you find those sellers pretty easily, then the odds are the market trades lower. If you go higher and higher prices bring in more activity, which is something that happens in the continuous two-way auction all the time, then the odds are that the market will continue higher. So we will look very closely at volume today. Now, it's a difficult day to measure because it's pre-holiday, but the principle is there. And what we're going to find that in the first half hour, the market is spending, you see the low, you see the market spending a lot of time trying to go higher. Now, we're currently playing it at two times the speed. So this isn't too far off of what you would see if you were in the market. Okay, Jen, how much time do we have left in the first half hour?
Less than 14 minutes.
Okay, let's speed it up just a little bit. Let's speed it up to 4 times. So understand we're playing at 4 times the normal speed you would actually see if you were trading the market. But I want you to get a sense of what's happening. So you see the market, we did not take out the overnight low. The green line to the left on the profile from Thursday, the round line, is unchanged from Thursday. Unchanged is always a reference when short-term traders are involved. If we come across one of those references like unchanged, the previous day's high or low, the overnight high or low, and the market goes right through it like it never even saw it, then you got a pretty good odds that you're seeing more serious buying in the market when the market's going up. If you see the market hesitate for some period of time around these references, and particularly the unchanged level, then that's an indication that we're looking at mostly short-term traders, and we're not looking at larger players that are really serious about what they're doing. And it's always so important. You'll hear us repeat it over and over again. There's 2 sets of emotions you have to really understand in trading. They're yours, and also the emotions and the attitudes and the objectives of those that you are competing against. So we'll watch if the market really is, you're competing against some really good long-term players, then you're going to go through those opening prices without, a lot of to do about anything. If you start hemming and hawing as you get to those levels, you got a pretty good idea that you're looking at more short-term traders who have less, ability to move the markets. So we're coming up just short of that level. Can you mark that level, Jen? It doesn't have to have a label on it. Yeah, there we go. So the red line is the unchanged level. So as we near the end of the first period, you can see that the market's stalling right around that level. So we're just a tick or so short of it right now. See, it's like a magnet. There it goes. The market's right at the unchanged level. Right at the unchanged level. We didn't go wrapping through to the upside. Market's hesitating there. Remember, we're playing at 4 times speed. Market's backing off a little bit. Okay, Jen, how much time before we change times?
Less than 2 minutes now.
All right, so it won't be long. We're going to see a time change. So in the first half hour, you've seen the market go almost straight up. You've seen it stop exactly at the unchanged level from Thursday. So that in and of itself tells you that it's a pretty mechanical market. It's mostly short-term buyers that are taking the market higher. If it was longer term, more serious buying, they could care less about unchanged. Matter of fact, they probably don't even know where it is. Now, I also look and I say, and we'll show you how to get the volume before you're out of the course, but the volume is 251,000 for the first half hour. About the lowest we normally see is 280,000. When you get into the high fours, early fives, that's a sign that you've got a lot of volume. So we're looking today at some of the lowest volume we've seen in some time. Yes, it's a holiday, but if the market, if the buyers are really there, we wouldn't spend so much time there and we wouldn't have such low volume. So when we're talking about thinking in terms of odds, you have to factor in the fact that volume was very low this morning. Also, we talk constantly about confidence. And that is something people always say, explain confidence to me, Jim. And I say, I can't explain confidence. You have to see confidence, and it has to be viewed contextually. I can tell you how slow this market moved this morning, the amount of time it went to exactly unchanged and stopped. Unchanged is the same as settle. And then we looked at the actual volume, 251,000 contracts. So I know that this is not a really high volume day or a high confidence day. Now, where a lot of you are going to fight this when you get into real trading, it's going to be that for some time this morning, you're watching price go straight up. Okay, now we're in the second period of the day. We did reach the overnight high. We've traded through it. And of course, once you trade through it, you start to hit the stops. There's going to be people that will have stops at the overnight high. So as you're watching this, you're watching price. I promise you, it is a tremendous fooler, because you keep thinking, boy, this market looks pretty strong. Look at the price. And if you look at, price-based indicators, it will show strength. Okay, now we looked up above the overnight high, and not unexpectedly, there were stops there, protective stops for people that had been short. So they've worked those out, and now the market's going higher once again. The next logical place that the market would look at would be someplace around the opening from yesterday, or where the market gets fat there. You say the ABC, DF, or DGIJ, just below the opening. Is it too late to mark the point of control up there at, no, come down one, come down. No, I'm sorry, I don't want that point of control. I want where the market gets fat, down there at the ABC, DFGI. Okay, up a little bit, up a little bit, up a little bit, up to the fat. One more, right there, that line right there. One above it, please. Okay, it doesn't have to be perfect. Okay, when I look at that, it just kind of jumps out at me, because it's fat. It's fatter up there than it is anything below it. So I'm looking at a level like that. Okay, and there's no science to it, and that's what people say. Well, Jim, I don't understand why that versus something else. It just caught my attention because you can see that the profile shape changes there a little bit. Okay, the market hit stops, backed off, and now it's running pretty hard again to the upside. But remember what I said, the volume wasn't there. 251,000 contracts in the first half hour. That's exceptionally low. When you see price go like you saw it just now in B period, remember, we're running at 4 times the speed, so it's a little more dramatic, but it's going to be all you can do to keep from buying that market. It's easy to get trapped. We looked below the overnight, we looked above the overnight range, and we traded higher. Remember, the volume was low. Remember that you could expect stops around the overnight high. So what is going on here is not that unusual. When the market's trading up near the morning high, as an experienced trader, not always a profitable one, but as an experienced trader, I'm looking for an opportunity. I shouldn't say looking, but I'm trying to observe when I think the opportunity comes to me. Now, on this morning, as the market was moving up towards that last high that you just saw, I was buying puts. A put, you want the market to go lower. The reason I was buying puts is the volume was low. I thought the market was fairly sluggish. I thought the overall volume was low, and I thought that you cover the overnight, and then what happens? The momentum traders jump on board. So it's a risky trade to kind of lean in front of the trade that like we call it, leaning into the wind a little bit. I won't be surprised if the market doesn't go a little bit higher up here. But when I look at it, and particularly what I was focusing on this morning was really how low the volume was. And when I see that volume, got a pretty good idea that there's a lot of short-term traders in this market. Again, I'm looking at what we call confidence. Now, this confidence wasn't as obvious. I was basing a lot of this decision on the low volume. There is nothing in the price movement to tell me the confidence is low. Now, as it starts to trade, now a little more time has gone on, and you see the market trading all the way back down to just a tick above the overnight high. Well, that's an indication to me that there's a little little softness in this market. That what I saw was what I thought I saw, mostly short covering. So you see the market's backed off quite a bit. You'll see also the white line just below the current price. It's just above the red line. The red line is the settle price from yesterday. The line right above it represents half back for this morning. Now the market, we've traded into the second period. You saw how far back that market came after making the B period high. If the market were really strong, that's very unusual. Now the market is one more time above the overnight high. A lot of volatility, a lot of chop going on in here. Remember, and this becomes important later on, I don't read this market as having a great deal of confidence. Yes, I see price going up, but if the market had more confidence, I don't think the market would have come back as far as we saw it come back in C period. But I suspect that what traders do when they got a market that's up like this, they're game to buy every little pullback. So as time goes on this morning, there'll be traders buying every little pullback. When they buy those little pullbacks, they're getting inventory longer and longer in the market. Now C period has opened, and we're well back again into the overnight range. The market really had the strength that price looked like it was giving it early on. We wouldn't trade back this far. Okay, so we'll watch this play. Remember, we're playing at 4 times the normal speed. So it's a little exaggerated. It looked like it's a little more exciting than it really was. But continue just to watch this market and play out in here. Jen, what speed? How much time do we have left in C period?
Less than 23 minutes.
Okay, let's speed it up to 6 times.
Okay.
Okay, so now we're going, 6 times the normal speed. So in 5 minutes, we'll go through a half an hour. So we see we're still well off the high. Once again, we're back into the overnight range. So this is the 3rd or 4th time we've been back there. When I see that one more time, it suggests to me that confidence is low. Now remember, the market's been going up since the opening. So there's going to be a lot of people following price, and they're going to still think the market's fairly strong. Now, when you look over on the far left, you see the value area from yesterday or from Thursday the 30th. The value area is considerably higher. Right now, we are trading within Thursday's value area. So the question becomes now, can we get minimum unchanged value relative to Thursday? In order to get unchanged value relative to Thursday, which means, kind of a total overlap, the market's got to trade higher fairly quick. Remember, the things that can change the value area are time, range extension, and time, or a good combination. So now the market has traded almost back down to the midpoint. Okay, it did trade exactly to the midpoint. That is, if we talk about fast traders, that's a place where a fast trader may come in and buy it. Though when you see those exact references are indications that the buying is done by very short-term traders. Very important concept. When it comes from those exact levels, these are weaker hands traders. These are not the traders that take the market substantially higher. It will happen on some days, but overall, you watch this over time, when it comes back to the exact level like that, that's usually a sign when the market trades higher from there, that inventory is getting longer and longer in the hands of the weakest players. Now that becomes very hard to grasp and understand. You will only grasp that over time. But to most people that are trying to learn to trade, nobody's pointed out something like that. If nobody's pointed it out, you don't have any real basis to learn from or make your own judgment. Now, you may find out that you don't believe in that, but at least somebody pointed it out and you have something to begin to observe. And the powers of observation are the most important thing in the world to me for trading. I still come back to say trading is a skill, not an art. As a skill, it takes a loose mind and it takes quite a bit of experience. It's not a science. You can't, in my opinion, you can't put numbers to it. I mean, we look at some numbers such as volume. Okay, one more time, we saw the market come back down to that halfway point. Now we've opened in B period, or in D period, and the market is still trying to trade higher. So look, all morning, we're trying to trade higher. Now, and this is the type of thing, when you see the price and you see it's kind of spurred up like it is right now, boy, you can't, well, I don't know, maybe I should own some of this. Maybe it's really going higher. So it's very misleading. You really have to have some real experience to have the confidence not to chase this market to the upside. Now, as a short-term trader, when the market twice now has rallied from exactly the half back level, when the market trades back up at this area, I'm adding on to my short position because I don't have any confidence that that low is going to be any good. Let's stop for a second. Okay, now remember, we're playing at 6 times the speed. So, the market's gone up and come down a little faster than you see it in real life. But remember, we said we traded down to that exact level twice, traded back up, and the last time, D period actually traded back up and took out the C period high by a single tick. But when I see it go up like that, having come from that exact level twice, I get a pretty good idea that the overall market is weak. And when I see that, when the market rallies up there, I am looking for an opportunity to add to my short position. If I wasn't short, I would see that as an opportunity to get short. Now, whether you get short with futures or with puts doesn't make any difference. They're both delta short positions, and that's what you're looking to do. So now we're back down for the third time to that half back level. Jen, let's go ahead and play it again. Remember, we're playing it 6 times. Remember, I'm just trying to think out loud. Remember what my position is. Now, I will admit, now we're back up there again. I will admit that even with the amount of time that I have been in the market and trading, and as many times as I've seen this, when that market rallies back up again, I begin to have a little self-doubt. I'm stubborn enough, I'm not going to change, but it does get to you. So you really have to be well-founded. All right. So now remember, we're playing 6 times speed. The market has come back down and it has taken out that half back level. Now it's a little trickier because now, okay, so it cleaned that up. Now you got to watch very closely what happens from here. Okay, Jen, let's turn it off for 1 second. So now there's some things that should go through your mind. As we've come back down here, and we're now in the 4th half-hour period for the day, so almost 2 hours has passed. The value area on your far left, not the overnight, but Thursday, you see it's going to be pretty difficult to get value area that just totally overlaps that because of how much time has passed today. Is it impossible? No. But again, if you're thinking in terms of odds, the odds are much lower that is going to happen. Okay, let's go back on. Now, what I'm faced with, I've already shared with you what my position is. Now I have to monitor for continuation on the downside. So you may say, wow, he's got himself a pretty good trade. Okay, I saw what he did. I saw why. It's, well, he's pretty good shape. But now the market is moving down. Now I have to monitor what is happening on the downside and how much confidence do I think the market has trading lower. Now it took out the halfway level, that white bar, came down and bounced back up to it. So I'm watching, I say, well, it took out the stops. It would have been at the, the halfway mark because there were, 2 periods the market stopped there. And then, but no real follow through. And the 2 periods would have been C period and the current period because it bounced, but now it's through it. But now you watch and say, well, how much follow through to the downside? Okay, now let's just kind of add up what goes through my head later on. Overall, the confidence was not high early in the day. We went up, the market failed. I thought it was because of overnight inventory. The traders got too long. Momentum traders jumped on the short covering. But I didn't think it was very much confidence. Now, but that adds on. It's not like we went up there and come straight down. So now confidence wasn't there early, but now we got to watch how much confidence on the downside. So now we're getting a little extension on the downside. Remember, we're running it 6 times. So, it's more exaggerated than it was. C period was an inside bar. An inside bar is a form of balance. And we then came out of that inside bar to the downside. That very often is a good short-term trade when you come out of balance. An inside bar is a form of balance. Right now, the market's trading lower. One of the things the market will be looking at, it'll be looking at the opening from this morning. The opening's the green dot. To have anything meaningful on my trade, I need to get down below that opening price. Okay, so right now I've got D period extending beyond the B period low, coming out of the inside bar and C period. Market's trading lower. How much time do we have in the D period left?
Oh, less than a minute.
Okay, so we're going to change times. We're going to change time again here very quickly. Okay, we're now in E period. So E period is trading lower. The market is down for the day because we are below the unchanged level. Remember, the unchanged level is the red line with the circle from the previous day. So now we're watching that to see if the market stays unchanged. Can you stop for a second, please? When we weren't running at 6 times speed, the market spent a considerable time back and forth through the unchanged level. It's not as clear when we're running it at 6 times. You know, instead of 30 minutes to play a half an hour, now it only takes 5 minutes. So, you know, it wasn't as obvious. And, you know, we just don't have the luxury of doing it every day, you know, playing at the regular speed. But again, I'm just telling you what happened. All right, let's go back on. So we made a high. We have an excess high from this morning. The market didn't crater from there. It went down to exactly the half back level. It rallied, came, you know, back down, rallied again. Now the market has finally turned to the downside. More than likely, the day time frame inventory got long. Overnight inventory was short. That was corrected. There were long players, probably the momentum players jumped on board. So we probably had some short-term long inventory, and that short-term long inventory is under liquidation right now. So the question is it joined by new money selling? Okay, now notice the opening price. E period's just a couple ticks from the opening price. The market is rallying. Okay, we've now gotten 4 wide up here. Not that there's any magic. Don't see any magic in 4 wide. The magic is in the understanding that, okay, that looks like a fairly obvious point. It's getting wider at that point than any other place. Can that wideness change? You know, can it move lower? Does it not move lower as the day goes on? Again, we're talking about confidence. If the market really had confidence on the downside, you're not going to leave it 4 wide up there and 3 and 2 wide below it. Okay, now the market, there we go. The market's continuing lower. It's down through the opening, which we said is always a reference. And it's just a tick short of the overnight, of the early morning low. So if we can stop for a second, remember we're playing it 6 times, but we now have no excess on the low. We have no excess because there's no single prints. E period fell 1 tick short of taking out the A period low. So now, can you stop for a second, please? All right. Now, what we saw, now E period now has come exactly to the A period low. And the market bounced from there. Why did the market bounce from that exact level? Because there are a lot of short-term traders, call them scalpers, that's what they do. They're looking for those exact levels to be buyers or sellers. They don't do a lot of homework. They think they're going to make their money just out of looking at the market, looking at the highs and lows, the opens, etc. Numbers that everybody can see. There are no secrets. So think of how many people are playing with those numbers. There's nothing unusual. There's nothing mysterious about them. Nothing camouflaged about them. All right, let's go back. Remember, we're playing at 6 times the regular speed. We have a poor low today. Poor low because there's no single prints. Okay, the market's now traded 1 tick below the early morning low. And you see you're getting a bounce. Now it's back. The next place that the market would be logically looking at, markets are very visual, will be the overnight low and yesterday's low. So the red line is yesterday's low. So if there's anything here, we need to get through yesterday's low. So far, the market's bouncing from that level. Back through the opening. All right, start recording. Remember, confidence wasn't high on the upside. Now, the confidence isn't low on the downside. If the confidence was high, and there was really good money in there, selling, the market will cut through these very visual references, such as unchanged versus yesterday, the overnight low, the opening. They'll cut through it without a pause. Now you can see those levels are providing trading opportunities for short-term traders. So we didn't take out yesterday's low. We didn't take out the overnight low. We did take out the early morning A low, and now the market's bouncing again. Keep in mind, we're still playing it 6 times. If the market were really that weak, we would not have hesitated. So the market's back again. It's going to come back again. Remember, the momentum is down now. And remember, when we came into the day, we talked the 3 profiles on the far left. We talked about how the shape and volume for those 3 days that took us to new highs was very questionable. So the market is, near the low of the second day, near the overnight low, near yesterday's low, and now it's extending. Okay, if we can stop just a second. Now, remember we commented that this market had took quite a bit of time to get out back through the opening price. When it did, then it bounced. So you see the A period low, we finally got down through it. And now the market's extending on the downside. You can start again. I commented early this morning that the confidence wasn't high on the upside. Now, I remember this day. I'm trading this day, and I'm watching pretty closely now and wondering, what do I do with my shorts? I'm down below yesterday's low. I'm down below the overnight low. And the reference I had set up was 28.92, which was the top of the single prints from the day the market broke out to the upside. It's a very visual reference. But now I've got my short positions on, and I'm wondering, when do I cover them? And I'm watching to see how much confidence do we have on the downside. So the market continues to trade lower. I'm watching the overnight low and yesterday's low. If the market's really weak, we don't come back into that range. So I see the market's getting very close to the reference I had. Now, too many times that, you get a trade like this, you get too nervous and get out too quickly, and sometimes you just have to let them work. Okay, so now the market's back up, and it just traded at the overnight low. Traded at the overnight low, and they sold the market. So again, very mechanical sellers using very visual references. Now remember, up above, ABDE, you can see it's 4 wide up there. Jen, if you can point up there with the half back and the ABDE on the high, 4 wide, that's an anomaly. It just kind of sticks out at me. If the market was a little smoother on the downside, it'd be a little more convincing. Okay, so the market's now trading back into the overnight range. This little bounce just a second ago, the high on that bounce was exactly at yesterday's low, or the low from Thursday. And they sold off the market again, not terribly convincing. So at this point in time, I'm looking and I'm saying, I don't think this market's got the overall confidence on the downside I think it should have. And the market's rallied back up to where you see it right now. That's a pretty good rally off the low. I had not covered any of my position. And I was having some serious self-doubts about myself because I knew I should have covered because I didn't feel the market. I didn't think the confidence was high going up, and I didn't think the confidence was particularly high going down. As we can see, the volume down in this level is 13, at this point, it's 13% behind what it was yesterday at this time. And yesterday was a very slow day. So we're not seeing any real selling. So at this point in time, what I have decided is that I've got my positions ready to sell, to get out of them. And I'm just looking to see, do I get lucky enough to get one more little push to the downside? And if I do, I'm coming out of those trades. It's actually a pretty nice profit. I don't want to let it get away. Okay, so we're back down below the overnight low, below yesterday's low, but the overall confidence hasn't been that great. So at this point in time, I say, I haven't liked the confidence up. I don't like the confidence down. So I'm out of that. I'm out of my total position, someplace down near that, wherever the market just, the low it just went to on that final period there. So now, I have no position. And I decide to do something. I decide to walk away from the market. Because of my experience, I know that sometimes I can second guess myself. And I've watched this market go down. I would like to tell you that I don't have that weakness, but it's something I've never quite overcome. Can I explain it? Can I talk about it? Absolutely. And that's certainly a lot different than saying, oh, I've mastered it, that's no problem. All right, so I'm out in that, someplace in that F period break. Now the market's back up into yesterday's range. So if the market were really that weak, it's unlikely we get back there. So now what are the short-term traders doing? Stop for just a second, if you will. This is important. Remember early on, the short-term traders this morning took the market higher. They piled on to the short covering relative to the overnight inventory. As the market traded above the overnight high, we said that the volume was weak, and then we saw the market spend, about an hour to an hour and a half above the overnight high, and the market, buying every little dip in there. We saw the market come back down to an exact level 2 or 3 times and bounce again. So I'm watching the short-term traders. They're late. If you think about on the buy side, they've watched the market go up the entire session. And now, as we get above the overnight high, they're now convinced that the market's going higher. We've all been there. We've watched it, and we finally throw in the towel, said I should be long. And of course, that's very close to the end of the rally. Now, the market, I said I didn't like the confidence on the upside. So now as the market's come down, it hasn't had a lot of confidence. We said just a couple minutes ago that the volume, as we got near yesterday's low and the overnight low, was 13% behind what it was yesterday at this time. So on a relative basis, that's not something that's going to give you a lot of confidence. Now, I'm asking you, what is a foundational course? I'm asking you to keep a lot of things in mind as you begin to trade. It's almost impossible for you to begin to trade and keep all of this in your mind, calculate it correctly, and be comfortable with the trading. We all know that. But once you get exposed to these ideas, now, as time goes on, you have a better opportunity to incorporate those into your trading scenarios. you have a better chance to make them real, to own them. But if nobody shows you what to look for to begin with, you can go years without ever having any idea of what you should be looking at and seeing in the market. When you're in that position, you're so often just flying blind. Now, I use the term this market doesn't have confidence, and I'm always asked for a definition of not having confidence. And I say, I can't give you that definition. It is a composite of things, and it's something that you have to see in action in order to incorporate it in making it yours. I'm often asked the question, well, what do you mean by acceptance or rejection? And I can give you a mechanical answer. You know, up at the high where you've got the single prints, well, it was rejected. But the whole process of how it went up and made that high, what happened after that, and then the market rallied a couple times, that is all part of having an appreciation for this idea of acceptance and rejection. It's not a single mechanical, clear-cut answer. It is an answer that comes through experience. So I thought the confidence was low going up. I now think the confidence is low going down. I'm totally out of my position. And now what does the market do? It comes down and makes a new low. Now remember, I said I walked away from the market. And it said, well, you know, with all your experience, believe me, we're all human. We make the same mistakes over and over. We just hope we don't make them as often. Okay, let's continue to play the day out. So remember my reference was 28.92, and that was because it was the highest price that had double prints on the day the market broke to the upside. So the market is now traded one tick below that. So we've had no acceptance down in those single prints. Remember my feeling that this market didn't have the confidence, and I stepped aside. Now let's watch what happens through the remainder of the session. Jen, let's speed it up. Let's make it to about 20 times. We're going to play this very fast because it's, you know, we're going to go through this very quickly. We've covered the really important things, the things that I want you to have an opportunity to really focus on. They won't be yours for some time, but unless somebody points them out to you, you have no way to begin to take them into your trading consciousness. It's just like when I was showing in tennis or in racquetball or even handball, what a good shot looks like. I could see the shot. I know what the shot is, but I haven't mastered the shot. It took some time for it to understand exactly how you play the shot. And there's no exactness to it because every time the ball comes to you, it's a little bit different. Every day in trading is a little bit different. But as you get experience, you can make those adjustments. I liken it very often to a really fine surgeon. A surgeon has studied, he's got experience, but even when he opens somebody up for an operation, he's never seen the exact same thing twice. But because of his experience, he can handle the changes or the unexpected that comes his way. Now, is it 100%? No, but he has a much better chance of giving you a satisfactory operation because of his experience. He can make the adjustments. All right, now we see that this, remember early on, I didn't think the confidence was there, and see how high this market has risen. Now, remember, there's going to be a lot of traders because they saw the market go down, still thinking about selling the market as the day goes on. And that's where the real problems come in. Remember, we're playing it 6 times, so it's greatly exaggerated is what this day really looked like. So we put in the new low. We've had quite a rally in the market. What was that rally? Was that new buying? Probably not. Probably mostly short covering. Those that got short taking back their shorts. Doesn't have to be, it can be a combination of both, but more than likely, that's what you're seeing. So we talked earlier about not having a lot of confidence. So we saw the market rally, and a lot of people are going to be all excited. They're going to say, "Oh, they want to buy those rallies." And then we see the market come back down again through the past the overnight low, past yesterday's low. So you're getting a lot of rotation in here. You see the market back down again to the overnight low. So this is almost an hour. So you see there's a lot of chop going on. If you look down here in the FGHI period, there's a lot of trading going on. A lot of people now think they know what's going on. Where were they at the high when the market was coming down? Now they're very active down here near the lows. Market spent more time down near yesterday's low and the overnight low than it has any other place in the market. And this is where so much trade is taking place. So much trade is taking place here where there is no opportunity. But think about all these traders. They now are willing to come in the game. Some on the short side, some on the long side. What do you think's happening to them? They're just getting chopped up. They're losing financial capital. They're losing psychological capital. Okay, so we continue on. We're in J period. One more time, the market's down near the low from the 30th, down near below the overnight low. So pushing the market, lower again. Look at all the activity down here. And where were these traders earlier? Now everybody and their brother thinks they know what to do with this market. There they go, taking the market lower again. Wait, they're selling every little rally. Look how the market's gotten fat up there. It's now 6 wide. The fairest price to do business is to put the cursor on what's the fairest price to do business, Jen. It's right there. And that's, what is that price? That is
28.9650.
Okay, so now just think about this. Think about all the trading that's going down here. And believe me, a lot of you are going to get caught in this. I've seen it so often. Here's where everybody's brave. Now they're doing all kind of trades. They're brave. Where were they when the market went up in the morning? Where were they on the high when the opportunities were really there? Now, all this trading is going on around the fairest price for the day. Again, ask yourself, where were they earlier? Remember, as I said, I walked away from the market after I got on my trade. Because I can promise you, as much as I can talk about it, right now, I can promise you, if you're sitting there watching that market glued to it, it's almost impossible sometimes to keep your hands off of it. You should be doing absolutely nothing in there. There's no real opportunity. You're getting these little short rallies up and down, and we call this area other traders just picking each other's pockets. There's nothing going on. There's really no advancement up, no advancement down. It's a very dangerous place to trade, but yet notice where the majority of the trading is taking place. Think about that. Start thinking about where do you have to leave it alone? And it's hard. You see all that price? Oh, I'm missing this opportunity, I'm missing that opportunity. Now we went down and checked out the all-time or the low this morning. Now we're back up to the high for the last 2 hours. Look at them. They sell it again. Down it goes. Down to yesterday's low and the overnight low. almost 3 hours in this tight range down here. All the activity's going down here. Where was everybody earlier? Okay, now we're getting later in the day. Well, we got a little more short covering rally in here, right? We're back to the opening price. See, late in the day, the market got itself too short down there. You know, all that selling on every little rally, they get themselves caught short near the end of the day. And the majority of traders are just getting chopped up. Remember this. These are the markets you have to stay out of. If you miss the morning up or down and you get caught in these markets, more than likely, it's going to be an even more frustrating day. Now, some days you'll get it right. You know, you'll buy the low on that last break and you'll make some money. And you'll think, well, I got this. Believe me, for every time you get it right, you're going to get it wrong the next time. This is not a market you should be trading. And I talk from very, very serious experience. How do you keep your head above water? You stay out of this lower portion of this market. Remember, all day long, went up, down. You had two good opportunities, up and down. But everybody's trading, all the volume's going on right down here in the lower end. Been on 1, 2, 3. We're going on 4 hours down here. Okay, we're coming into the close. Look, we're getting another rally. Another short covering rally in here. Just feel how short that market got down there. Remember we said the confidence going up wasn't good this morning. The confidence wasn't going down wasn't good. I took my profits, I stepped aside. And the reason I stepped aside, I didn't think there was decent confidence on either side of the market. When the confidence isn't there, step aside. Now you're coming into the close for the day. You get all those people that were late coming to the party on the short side. Now they're getting squeezed as the market gets ready to close. What do you think they feel like? It's, oh boy, there was a lot of money to make there, Jim, if you got it right. Yeah, there was. But the majority of people didn't get it right. When you get these short covering rallies near the day, they're just squeezed. You know, near the end of the day, going into a long weekend, the panic sets in and they're coming in to buy the market, covering their shorts. And now what happens when this goes on, smarter traders, once they realize they're being forced to cover, they may pile on and add more pain to the shorts. So now you're into the runoff period of the day. We're almost back up near the high. Okay, we'll just let this run out. But I wanted to take you through today. I think it's one of the most educational sessions that we've had seen. It's a rotational day. It was a good example of confidence. It also brought home this idea of volume. Volume was low going up, low coming back. You saw the market spend 1, 2, 3, 3.5, part of 4 hours on the lower end. And you saw the market, you saw these people selling down there. And guess what? They did all that trading after watching the market come down. And now you got the short squeeze going into the close for the weekend. There's a painful days if you get them right. Somebody said, oh, if you get them wrong. Somebody said, well, I would have caught that move to the upside on the short covering. Let me tell you, for the one time you make it, you'll miss it the other times. You'll be caught short and then you can't decide if you're going to cover or not. Anyhow, this was everything but a foundational or introductory day. But remember what we said earlier. When you start to learn to trade, there are no practice fields. Okay, we'll go on and we'll have more to show you in the next playback.